Welcome, ladies and gentlemen. I am an expert specializing in U.S., Korea international politics, geopolitical security, and foreign exchange markets. The primary purpose of producing this video lecture is purely academic and analytical, to examine international finance theories, macroeconomic metrics, and foreign exchange vulnerability through an objective lens. This presentation is designed as an educational, nonpartisan lecture for political science and economic analysis. It does not intend to target, criticize, or disparage any specific individual or entity. If you find this objective research-based breakdown helpful in understanding complex geopolitical risks, please remember to like, share, and subscribe to the channel to support further scholarly content. Lecture content: Structural Vulnerabilities of South Korea's Foreign Exchange Reserves under Geopolitical and Economic Shocks. Even in the event that the United States triggers Special 301 proceedings against South Korea, non-experts routinely dismiss warnings of a foreign exchange crisis based solely on a single headline. Figure South Korea's foreign exchange reserves of $427.36 billion. From the standpoint of international monetary theory, this reliance on an absolute figure represents a textbook case of money illusion and a fundamental neglect of the base rate. From the perspective of financial economists and international finance specialists, a rigorous examination of vulnerability metrics reveals why the current reserve cushion is structurally fragile when confronted with massive capital flight. 1. The pitfall of the IMF. Assessing reserve adequacy, ARA metric. Massive portfolio liabilities. When evaluating reserve adequacy, the International Monetary Fund, IMF, looks beyond simple import coverage or short-term external debt. It employs a comprehensive composite index known as the Assessing Reserve Adequacy, ARA metric. Foreign exchange crises stem not only from a refusal by foreign creditors to roll over short-term debt, but also from rapid capital outflows out of domestic equity and bond markets. Under a floating exchange rate regime, the standard IMF ARA formula is expressed as $AR short text term debt times 30%, foreign portfolio investment times 15% broad money, M2 times 5% exports times 5%. South Korea presents a unique structural vulnerability due to its fully liberalized capital account. Foreign holdings of domestic equities in Korean won denominated. Bonds classified as foreign portfolio investment, FPI, are immense. The combined value of foreign-held listed stocks and bonds routinely surpasses $700 billion. Consider a stress scenario. Should foreign investors grow alarmed by U.S. Special 301 sanctions or non-market policy interventions such as speech-suppressive regulatory measures or massive administrative fines and attempt to liquidate just 30% of their portfolio holdings to convert into U.S. dollars, the capital exodus alone would reach approximately $210 billion. If this outflow coincides with trade deficits and short-term debt obligations, a reserve buffer of $427.36 billion would be cut in half in short order, triggering immediate market panic. 2. The Guidotti-Greenspan rule and the collapse of the rollover ratio. The Guidotti-Greenspan rule, a classic benchmark for international liquidity adequacy, stipulates that a country's foreign exchange reserves should cover 100% or more of its short-term external debt falling due within 1 year. Non-experts argue that because South Korea's short-term debt typically hovers around $150 billion, reserves of $427.36 billion provide nearly threefold coverage, guaranteeing safety. However, this assumption suffers from a fatal misconception. The core vulnerability lies in the illusion of maturity structures. Foreign exchange crises rarely erupt because baseline, short-term debt metrics look poor on paper. They erupt when foreign banking institutions refuse to roll over maturing credit lines. If severe U.S. economic sanctions are enacted Risk premiums on South Korean sovereign credit will surge. Under normal market conditions, the rollover ratio sits between 80 and 90%. If that ratio drops below 30% during a crisis, debt instruments, previously classified as long-term liabilities, can suffer acceleration or cross-default. Triggers: facing early redemption pressures. Consequently, the actual debt repayment burden can rapidly expand toward $400 billion. 3. Internal capital flight. The limitations of reserves relative to broad money M2. Foreign exchange crises are not driven exclusively by foreign investors exiting local assets. When domestic confidence in the national currency erodes, a far more destructive wave of dollarization occurs as local corporations and households rush to exchange local currency for U.S. dollars. In South Korea, broad money, M2, encompassing currency in circulation and short-term deposits, totals roughly 4,000 trillion Korean, one equivalent to approximately $2.7 trillion to $3 trillion. If public economic confidence collapses driven by corporate overregulation, forced corporate investment mandates or micro-interventions, and high net worth individuals or major commercial entities attempt to convert just 10% of M2 into U.S. dollars to transfer capital overseas, that demand alone would consume $270 billion to $300 billion. A reserve balance of $427.36 billion cannot sustain internal capital flight of this magnitude, alongside external obligations. 4. Qualitative constraints, nominal reserves versus usable reserves. The published sum of $427.36 billion does not represent immediately deployable cash on hand. The portfolio architecture of the Bank of Korea is primarily locked in securities, including U.S. Treasuries, agency bonds, and corporate debt. During a sudden crisis demanding physical U.S. dollar liquidity, attempting to liquidate vast tranches of these fixed income assets into a volatile market causes bond prices to slump and yields to spike, inflicting severe valuation haircuts on the reserve balance itself. Because the total ledger amount of $427.36 billion cannot be mobilized without incurring significant losses, speculative market actors recognize the central bank's reluctance to liquidate treasuries at a loss, emboldening aggressive currency, speculation and short-selling positions against the currency. Analytical synthesis. In sum, foreign exchange reserves of $427.36 billion act as a viable balance sheet buffer, primarily during stable market conditions. In a compounding scenario where extreme external shocks, such as U.S. Special 301 sanctions, converge with a breakdown in domestic policy credibility, three distinct pressures materialize simultaneously: liquidation capital from foreign equity and bond sales, accelerated short-term debt maturities resulting from rollover refusals, and internal capital flight by domestic residents seeking dollar assets. When these three forces merge into a perfect storm, reserves of $427.36 billion can be depleted within months, if not weeks. The assertion by non-experts that a foreign exchange crisis is a dynamic impossibility remains a dangerous misjudgment that ignores the mechanics of international finance. Concluding critique and epilogue. To conclude our lecture, we must reflect on the mindset that dismisses structural risks by looking only at surface numbers. The ancient Eastern classic, Zhou Commentary of Zhou, contains a timeless warning. 居安思危，思则有备，有备无患. When in safety, think of danger. Thinking of danger leads to preparation, and preparation prevents disaster. To rely blindly on the nominal figure of $427.36 billion, while ignoring underlying capital dynamics, is to disregard this ancient wisdom. Pride and policy hubris lead to systemic blindness. when decision makers mistake temporary stability for absolute immunity. They invite the very crises they declare impossible. Sound statecraft and economic governance require unrelenting vigilance, rigorous stress testing, and humble recognition of market realities. Thank you for listening. If you found this scholarly analysis valuable, please consider subscribing to the channel, liking the video, and sharing it with colleagues and students of international relations and finance.